Hazeltine LLC, non-Wall Street financial solutions. We help our customers escape the banking cartel and find true financial independence, but you won't find it in your typical Wall Street investment vehicles. Let us help you find the shortest path to true financial independence by escaping the matrix. Standard disclaimer, this is not investment, legal, or tax advice. This is for informational purposes only. Now I want you to think about how much money you have in the bank, in basically cash, checks, checking, savings, money market, CDs, etc. And now I want you to think about how much money you have in the market, in stocks, in bonds, in mutual funds, your retirement accounts, etc. Now, how much money do you have in the bank? Well, I'll tell you how much money you have in the bank. $0.00. You have no money in the bank. Because when you deposit your money in the bank, it's actually no longer yours. Now the bank legally owns your money and you become an unsecured creditor of the bank. So what you've actually done is not deposited money into an account that you control, but rather you've made an unsecured loan to the bank and you become an unsecured creditor of the bank. Some of you may be familiar with what happened in Cyprus as an example, where insured deposits were raided in order to make the bank whole. And they can legally do this because technically it's their money, not yours. So you have nothing in the bank. All that money in your bank account actually belongs to your bank, not to you. So how does a free checking account work? Again, all these bank accounts that we have, we're typically not being charged any fees, okay? And most people like the idea of not being charged any fees. I would argue exactly the opposite. You should want to be charged high fees because that means you're getting a high quality product. But when a very profitable business offers you something for little or nothing, it should make you suspicious. They're making money somehow. So how are these very profitable businesses making money in your bank account without charging you any fees? Well, I'll tell you. It's called fractional reserve banking. What happens is the money that you put into the bank is not really a deposit being held with your name on it. The bank takes that money that you think you own, but they actually own, and they loan it out to others and they charge interest on that loan. And this is how they make money. So we pay indirectly through inflation. The value of our money becomes worth less and less over time because through this process, the money supply is expanded. And so we are paying through inflation. So we're paying quite a bit if you think about how inflation works, but we're being charged indirectly, not directly. So we're paying for it. It's not free. Now, the Federal Reserve, which regulates this whole system, sets the reserve ratio, which tells the banks how much they have to keep on reserve and how much they can loan out. Hence the name fractional reserve. They have to keep some fraction of your money on reserve and the rest they can loan out. Now, what do you think the current reserve ratio is? How much do you think the banks have to keep on reserve and how much do you think they have to loan out? Well, historically, that reserve ratio has been about 10%, so pretty low. So you deposit $100, they only have to keep $10 on reserve with your name on it, and they can loan out the remaining $90. But what is the current reserve ratio? Well, the current reserve ratio is actually 0%. That's right. It's no longer a fractional reserve banking system. It is a no reserve banking system. They don't have to keep any of your money, which is actually their money, on reserve. They can loan all of it out. And if you want to check, this is a screenshot just straight from the Federal Reserve's own website, hiding in plain sight. 0 is the reserve ratio. So as of March 26 of 2020, the Federal Reserve removed all reserve requirements. It's now a no reserve banking system. All of the money that you deposit in the bank belongs to the bank and they can loan all of it out, keeping none in reserve. Now to return to the second question that we asked at the beginning, how much money do you have in the market? So here we're talking about your typical so-called investment vehicles like stocks and bonds and mutual funds and 401ks and IRAs. How much money do you have in the market? How much money do you have in these vehicles? Well, I'll tell you. The answer is nothing. You have no money in the market. You have $0.00 in the market, regardless of what your account balance says. Okay? When you purchase any of these so-called securities, stocks, bonds, mutual funds, contribute to a 401k, etc., all of those securities are held in what's called street name, which means your broker actually owns that stock, not you. And if you want to test this, call up your broker, call up your 401k administrator and ask them, please send me my share certificates, right? Please send me the proof that I legally own these assets. They will not be able to do that because you own nothing. Again, there's a Wall Street middleman who owns all of that, not you, okay? And as we've seen in some occasions, they can limit selling, as an example, of the assets that you think you own. So again, you own nothing. There's a Wall Street middleman who owns all of those securities. So how does a free brokerage account work, right? Again, I want to be charged high fees. I don't want to be charged low or no fees, okay? It should make you suspicious when a very profitable business like these large brokerage accounts, these 401k administrators charge you no fees. They're making money somehow. So how are they making money if they're not charging you any fees? And the answer is two things. First of all, fractional reserve banking applied to the stock market. So the broker takes your share of stock that you think you own, but they actually own, and they'll loan it out, as an example, to a short seller, and they'll charge interest on that loan, okay? The other thing they'll do is they'll front run the order flow. Let's say they get in a bunch of buy orders for Microsoft. What they can do is they can buy a call option on Microsoft and then execute all those buy orders they have from their customers, thereby driving the price of Microsoft up, and then sell their call option at a profit, driving the price of Microsoft back down. They just robbed their customers of the gains in Microsoft's share price they should have seen. Okay, so they front run the order flow, and they can do the same thing to the downside. If they get into a bunch of sell orders, they can short the stock and repeat the same process. Okay, so again, we are paying indirectly through inflation, through dilution of the value of the securities that we hold. The stock market has done very well in the wake of COVID. Okay, but when you look at the obscene amounts of money that have been poured into the stock market, it really should have gone up 10 times as much, but it didn't, because the vast majority of the money that goes into the market gets soaked up by Wall Street middlemen through surreptitious processes like these. So again, in these and other ways, we are being robbed, we are being skimmed from constantly in all of our standard Wall Street accounts, from your checking to your savings to your money market to your brokerage account to your 401k, your IRA, all of these vehicles. There's a Wall Street middleman who actually owns the assets, not you, and he's skimming from you constantly. So changing gears slightly, this is sort of my philosophy of investing. I doubt it's original with me, but the idea is very simple, right? Offense wins games, defense wins championships. I agree with Warren Buffett, arguably the most successful investor of all time. Rule 1 of investing, never lose money. Rule 2, never forget rule 1. So you start with very safe, liquid savings vehicles, then you can move into investing and even into speculating, but always keeping your position sizing rational according to the visual here. And I think this makes perfect sense when everybody sees it, and nobody wants to lose money. So I think most people would agree with this in theory. The problem, though, is that while most people agree with this in theory, and they might think they're following it, most modern portfolios actually look like this, because Wall Street propaganda has led us to confuse investing with speculating. Most people, whether they realize it or not, have the vast majority of their so-called investments or their savings in highly speculative Wall Street vehicles. So any of these standard vehicles that you typically see, stocks, bonds, mutual funds, 401ks, IRAs, etc., all of these are actually speculative investment vehicles. And this is one of the reasons why so many people are nervous about retirement, even if they've built up a decent sized nest egg, because their nest egg is all inside of a highly speculative asset where they really don't have control over the capital. They don't know what it's going to be worth in the future. Who knows what the market is going to do? And so they're nervous because their portfolio actually looks like this. So how do we distinguish between investing and speculating? Well, speculating can be summed up in the phrase buy and hope. And this is what we've all been programmed to do. Buy something, like a mutual fund, and hope it goes up in price, right? So we're hoping for capital gains, but we're typically not collecting any meaningful income along the way, if we're collecting any at all. We have no control over how that company performs. We have no control over how that stock performs. And as we've seen, those two can be completely unrelated. As opposed to traditional investing, which is all about cash flow. It's all about increasing your passive income. If you want to know if you have real investments or not, ask yourself, how much do your investments pay you? The answer is usually zero. That's because they're in speculations, not investments. So the idea traditionally was you start off life with your active income, right? Your full-time job, your business, whatever. That provides you with your income. Over time, you take what you're able to save and you put it into investments that yield you passive income. And once that passive income stream rises to the point that it can replace your active income, at that point, you become financially free. So traditionally, when you bought a stock, you owned something real. You got a share certificate signifying that you are now part owner of Ford Motor Company, which entitles you to a share of the profits. So all of the stocks on the market paid a very healthy dividend. People were not buying stocks to speculate on the price. They were buying stocks to collect that passive income. So what is the price of the stock? Who cares? You're collecting a share of the income, a share of the profits. You're not worried about what the price of the stock is. Now, when you buy a real, valuable asset, two very important things happen. Number one, you get a title, right? Signifying that you are the legal owner of this asset. If you buy a car, you get a title. You buy a house, you get a title. And that title is so important that people will buy title insurance to make sure that they own the asset free and clear. The second thing that happens is you insure the asset. Right? If you buy a valuable asset, you're going to protect it by buying insurance. You buy a car, you buy car insurance. You buy a house, you buy homeowner's insurance. It's the prudent thing to do. This is just plain common sense. Okay. When we buy Wall Street so-called assets, neither of those two things happen. We get no title because we own nothing. There's a Wall Street middleman who actually owns the asset who's skimming from us. And number two, you can't insure it. Take your $1 million stock portfolio to an insurance company and say, hey, I would like to retire on this, so can you please insure it so that I can have a safe retirement on this? They will not write you a policy, right? That should tell us something. These guys are professionals at pricing risk, and they will not insure these so-called Wall Street assets, okay? That should tell us something. Okay, compound interest. It's been called the eighth wonder of the world. Many of you, I'm sure, are familiar with how this works. It's hard to imagine given how low interest rates are right now. But just to review, the idea here is very simple but very powerful. Time works in your favor. So you take a decent amount of money, earning a decent interest rate, right? You put it into an interest-bearing account, and the interest you earn compounds, meaning you earn interest on the interest. So you get this very nice, ever-steepening curve as time goes on, right? So as that compounding curve works in your favor, the curve gets steeper and steeper, and your monetary balance goes up faster and faster over time, which is great. Fantastic. The problem, of course, is that we can't just leave all of our money continually compounding earning interest, right? We have to withdraw it. We have bills to pay. We've got to pay for groceries, health insurance, homeowners insurance, etc., right? We've got to continually withdraw money in order to pay the bills. And every time we withdraw money, we reset that compounding curve, which is bad for us. But what if there were a way you could do this without interrupting the compounding curve, where all of your cash would earn uninterrupted compound interest as if you never took anything out? So as you tap your cash savings in order to pay the bills, your interest continues to earn unabated. So as you pay yourself back by depositing your paychecks back into the account, you come out to a higher point along the curve to the right here, as shown here. So you continue to earn uninterrupted compound interest even as you tap the money that's in your cash account. Wouldn't that be nice? Think about how powerful that would be, where every single dollar you put into this account earns uninterrupted compound interest from now to the day you die, even while you're using it. And there is a way to do this, which I'll show you. Very powerful. Okay, so let's review what we've been over. We've reviewed several characteristics of your standard Wall Street vehicles, okay? There's typically a Wall Street middleman who actually owns the asset, not you, and he's skimming from you constantly. There's risk involved. It can lose value. There's no guarantees. You're exposed to market risk. Typically, it provides no meaningful income. We're hoping for capital gains instead. Any gains we do make are going to be taxed. It's a recent innovation. So yes, banks and stock markets have been around for a long, long time, but in their current embodiment, they really operate more like casinos rather than traditional banks or stock markets. It's not creditor protected, so if you become the victim of a frivolous lawsuit, if you get into financial trouble, if you, God forbid, go through some ugly divorce, potentially lawyers and creditors could come after those assets. Estate taxes also apply, so not only is it taxed while you're alive, potentially it's taxed before it goes to your heirs as well. And then we don't have time to get into this, but it feeds the banking cartel, and this money that they're skimming from you is, let's just say, not used for the most virtuous of purposes, as you can probably imagine. But what if there were a better way? What if there were a more traditional vehicle operating along more traditional investing principles that are more bedrock, where you, first of all, you actually own the asset. You own it, you control it, you have contractual rights over it. There's no Wall Street middlemen between you and your asset. There's no Wall Street middlemen constantly skimming from you. It's completely risk-free. There is no market risk involved. There are contractual guarantees associated with it such that the value of your account is contractually guaranteed to go up every single year, no matter what the market is doing. So we're not worried about market risk. Okay, it's sort of insurance. Pays a healthy income, so we're not hoping for capital gains, we're collecting income. It's completely tax-free, not tax-deferred like a 401k, but completely tax-free. These vehicles are hundreds of years old. You can see how they continued to relentlessly perform all through the Great Depression, World War II, the stagflation of the 70s, the dot-com crash, the 2008 financial crash, this most recent COVID crash. They've been absolutely bedrock. It was as if those times of severe economic dislocation never happened, because these vehicles are based on sound principles, not Wall Street gambling principles. So again, you're not worried about what the market is doing. It's a non-includable asset, which means creditors and lawyers cannot come after it. It also means if you're applying for financial aid, let's say to put yourself or a child through college, you do not include this asset on that application. And it provides for a tax-free legacy transfer. So not only is it tax-free while you're alive, it goes to your heirs tax-free as well. And then, of course, as you may have guessed, this sort of vehicle exists outside of the Wall Street banking matrix. Okay, so what are we talking about here? What's this magic asset? Well, there's no magic to it. It's just that it's very traditional, based on traditional sound principles. So the idea here is very simple, and I want to be clear that the concept comes first and the vehicle is secondary. So I don't want you to get too hung up on the vehicle and the mechanics because the concept itself is very simple and very sound. And the idea is simple. You become your own banker. So instead of using the commercial banking system, which is skimming from you all the time, you use your own private bank where you now recoup all of the money you're surreptitiously losing to these Wall Street players all the time. Okay, so it's called the infinite banking concept, and I encourage you to do your own research about this. What we are doing is we are using a very specifically structured, dividend-paying, whole life insurance policy as your private bank. And I want to emphasize again, the concept comes first. We're not talking about whole life insurance here. We're talking about banking. Okay, that just happens, whole life insurance just happens to be the vehicle we use, and it has to be very specifically structured. 99.9% of life insurance agents have no idea how this works. Okay, we are not structuring this policy for life insurance. We are structuring it for banking, and I agree with Nelson Nash that whole life insurance has been misclassified. Yes, it is life insurance, technically speaking, but once you understand how it works, you understand it has a lot more in common with banking, actually, than life insurance. So whole life insurance has a death benefit, like all life insurance does. And if you had term life insurance, that's all you get, a death benefit. But whole life insurance also grows cash value. And this is what we're going to be focused on. We are going to use the cash value of a properly structured whole life insurance policy like a checking account on steroids. So how does it work? So we're going to make premium payments into our policy to deliberately overfund the policy and hence grow cash value. And you can think of these premium payments like deposits into a checking account, except it's not a JP Morgan Chase checking account. It's a checking account that you control. So today you run 100% of your cash flow through a checking account, right? Your paycheck comes in, you direct deposit it into your checking account. That's the first step you take without even thinking about it. Tomorrow, you'll do the same thing, except you're going to deposit it into your own checking account that you own, you control, and you can realize enormous benefits from. So on that cash value, we are being paid interest at a contractually guaranteed rate by the insurance company. So our cash value is contractually guaranteed to go up every single year, no matter what. Why? Because this is an insurance company. An insurance company, the service they provide is they absorb risk for their customers, right? So this is exactly the opposite of the relationship we have with Wall Street. With Wall Street, we take on the risk. They collect their fees regardless of performance, and we take on the risk. Here, it's exactly the opposite. The insurance company takes on the risk because that's what insurance companies do. So no matter what the market is doing, our cash value is contractually guaranteed to go up every single year. In addition to interest, we are also being paid dividends, right? So as soon as we start depositing cash, we get paid interest and dividends, continually compounding on that cash value. Why are we being paid dividends? Because again, these are very specific policies with what are called mutual insurance companies. Okay, a mutual company has no stockholders. The owners of a mutual company are the policyholders themselves. So when you take out a whole life insurance policy from one of these companies, you become part owner of the company. Except this is a meaningful form of ownership, unlike a stock, where you now collect a share of the profits. That's where the dividend comes from. So you get paid dividends on your cash value. The companies I work with have been paying dividends for over 150 years straight. Think about that for a second. Unbelievably rock solid performance all through the Great Depression, all through these times of severe economic dislocation. They continue to relentlessly pay dividends because, again, their business model is based on bedrock financial principles, not on Wall Street gambling principles. So we're not worried about what the market is doing. We are getting paid no matter what. Now here's where the magic comes in. Here's where we get, as I mentioned before, continually uninterrupted compounding. So here's how we can ensure that our cash value, we continue to earn uninterrupted interest and dividends, continually compounding, even while we're using the money in our bank account. So if you have $100,000 in your standard savings account earning interest, and let's say you want to withdraw $50,000 to make a down payment on a home. Well, you withdraw your $50,000, and now you're only earning interest on the remaining $50,000, right? Here, that's not the case. When we withdraw our $50,000, we're going to still keep earning interest and dividends on the full $100,000 principal balance. Now, how do we do that? Well, let's say we have $100,000 in cash value in our whole life policy, and we want to take out $50,000 to make a down payment on a home. We do not withdraw the money. We borrow against our cash value. So we take out what is called a policy loan. So we take out a $50,000 policy loan, and then we use the proceeds of that loan to make the $50,000 down payment on the home. Why would we do that? Because now we are still earning interest and dividends on the entire $100,000 principal balance. Again, think about how powerful that is. A policy loan is a contractually guaranteed right that we have. Okay, we actually have more contractual rights and guarantees over cash value in our whole life policy than we do over a checking account, where there's all kinds of limits and problems potentially if you want to access a large amount of cash at once. Now, a policy loan is not a debt. Some people get scared when they see the word loan. Policy loan is not a debt, and there's actually a Supreme Court ruling that has said this. Why? Because you incur no liability whatsoever. You never have to pay a dime of that loan back ever if you don't want to. So it's not a debt. If you never pay a dime of that loan back, the insurance company doesn't care. Now, why are they being so generous? Why is the insurance company giving you a loan and not expecting any payment from you? You pay them if you want, but they don't care. Well, the answer is in the collateral, right? Think about the collateral we're using to acquire this policy loan. The collateral is the cash value of a life insurance policy that the insurance company themselves are guaranteeing. They are guaranteeing that cash value is going to grow every single year. So they know for a fact the value of your collateral, the cash, will always be higher than the value of any outstanding policy loan. So they're not worried about your ability to repay that loan. They know they're going to be made whole no matter what. Let's say you have a whole life policy with $1 million death benefit, and you take out a $100,000 policy loan and you never pay it back. You drop dead the next day. Well, all the insurance company does is they take the $1 million death benefit, they subtract the $100,000 that you owe them, and your heirs get $900,000. It's very simple. So the insurance company, for them, this is the safest investment they can make. They're making you a loan where they know with absolute certainty the collateral backing that loan is always worth more than the loan outstanding, which is why they don't require any repayment terms. Very generous. So functionally, it's the same as a withdrawal because you never have to pay any of it back. The difference is that now we get paid interest and dividends on the full principal balance, even while we're using some or potentially all of the cash value. Think about how powerful that is. Every dollar you put into your own private bank earns uninterrupted interest and dividends compounded from now till the day you die, even while you're using it. Extremely powerful. Everything here is completely tax-free if it's set up and managed properly. Why? Well, for two reasons. First of all, it's insurance. If you have homeowner's insurance and your home burns down and the homeowner's insurance company writes you a $500,000 check, that's not taxable income. You're being compensated for a loss. You don't even report that to the IRS. Same thing here. Not only is it tax-free, it's not even reportable. Think about how peaceful your life will be when you have a warehouse of wealth that's not even reportable to the IRS, and it's contractually guaranteed to go up every year. Think about how peaceful your life will be not having to worry about what the market is doing or what the IRS might do. Okay. The other reason it's tax-free is because we haven't taken any income out of it. Everything we take out of the policy, we do it by way of a policy loan. Therefore, it's a loan. It's not taxable income. It's a loan. It's just that it's a loan we never have to pay back, and the cash value is going to be growing faster than the loan balance. Okay. There are contractual guarantees associated with multiple parts of this policy. Okay, the interest is contractually guaranteed, the death benefit contractually guaranteed, etc. Because again, this is an insurance company. What do insurance companies do? They absorb risk. That's the value. That's the service they provide, right? So unlike with Wall Street, where we absorb the risk when we invest in one of their so-called assets, here the insurance company is absorbing the risk. Again, dividends are paid. Dividends and interest are paid on the full principal balance, even while we're using it via the policy loan. Okay, and then I just want to emphasize again, infinite banking, it's a concept first. Whole life happens to be the vehicle we use. So if you don't understand some of the mechanics here, that's fine. Don't get too lost in that. The concept is very simple, and you can go deep into the mechanics here if you want. But remember, the concept is very simple. You become your own banker. Okay. And then, if you're working with someone like me who knows what they're doing, I can handle all the details of the mechanics behind it, and you can get as deep or as shallow into that as you want. That's not as important as making sure you understand the concept, because some people think this is about whole life insurance. It is not about whole life insurance. That's the vehicle we're using, but we're using it as a bank. Okay, it's not the violin that matters. It's how you play the violin. Same thing here. It's not whole life insurance. It's how we're using it as our own private bank that matters. Okay, and lastly, I want to just show one small illustration of how this might work to hopefully bring the concept home. And I hate bringing up numbers because people get lost in numbers and I think they distract away from the concept. But I just want to do one illustration here to show you how this could work. Okay, so Nelson Nash uses the analogy of flying a plane. Right? Think of your financial journey from flying a plane from point A to point B. Point B being financial independence, wherever you want to get to. And obviously we want to get there as fast as possible, right? So everyone focuses on the engine speed of the plane. I want to squeeze out 120 miles an hour instead of 110 miles an hour, right? That's analogous to return on investment, okay, which is what everybody is focused on. But Nelson encourages us to focus instead on what environment are we flying in? Are we flying into a massive headwind? Which most of us are, because of all the ways in which Wall Street is robbing us all the time. We're flying into a massive headwind. What if we can instead fly with a massive tailwind behind everything we're doing, which is what the infinite banking concept allows us to do? We have now a massive tailwind behind everything we're doing, okay? It adds rocket fuel to whatever you're doing. You don't have to change your investing strategy at all. This is not about investing. We are not talking about investments here. We're talking about banking. Everyone uses a checking account. I don't care what your investment strategy is. It doesn't matter. just use your own very powerful checking account instead of a Wall Street checking account that robs you. So this massive tailwind allows us to recoup all of the interest that we're losing surreptitiously to the banks all the time. Again, return on investment. Well, how much of your money are you actually able to save and invest? 10%, 20%? How much of your income are you saving and investing? And we're trying to squeeze out a few more points of return on the small percentage of our income we're able to save. What about the 80% of your income that's just going away? That's just going to your living expenses. Let's focus on that, right? What if we could make a return, a compounded return on that? That's what the infinite banking concept allows you to do, where every dollar that comes into your shop never truly leaves your shop. We stop all that leakage. Okay, so here I'm going to show you how you can quadruple your return on investment without changing anything, just by running your cash flow through your own bank. So I don't like return on investment as a metric, but if we're going to look at return on investment, let's look at it holistically, not just on the 10% you're able to save and invest, but on your entire income. So let's say you bring in $100,000 in income. You deposit that money in the bank, and then let's say you spend $80,000 on your living expenses, and you save and invest the remaining $20,000. And let's say you're getting a 12% return on that investment. So to make the arithmetic easy, let's say 10% net of taxes. So after a year on that $20,000 investment, you'd have a $2,000 net gain. Pretty straightforward. Okay. Now let's repeat that exact same scenario. You bring in $100,000, you spend $80,000. You save and invest the remaining $20,000 for a 10% net ROI. Except now you're going to deposit the money at your bank. So everything stays the same, except instead of depositing the money at a commercial bank, you're going to run that cash flow through your own private bank. What does that do? Well, in this example, you are being paid a 6% tax-free dividend on the entire $100,000, because every dollar that flows through your bank, you collect that dividend, even if you spend it. So now we have an additional $6,000 net gain on top of our $2,000 net gain for a total of an $8,000 net gain. So without taking on any additional risk, without changing our investment strategy at all, without spending less or saving more, simply by running the money through our own bank, we have now quadrupled our return on investment. So again, we're not talking about investing here. We're just talking about banking. You don't have to change your investment strategy at all. Do whatever it is you're doing, but run your cash flow through your own bank. And I will put some resources for further reading below. But if you're interested in learning more about this, the place to start is to buy and read Becoming Your Own Banker by Nelson Nash. For some reason, it's sometimes not available or super expensive on Amazon, but if you go to the Nelson Nash Institute, which is infinitebanking.org, again, I'll have links below, you can buy it for less than $25, I think. So buy and read that book. It's less than 100 pages. It lays it out very simply. If you want to learn more about this and you're interested in potentially pursuing it and setting up your own private bank, please contact me, set up a consultation, or email or call me via the links on the page below. I look forward to speaking with you. Thank you very much.